All right, today we are putting on our detective hats. Why? Well, because every company's financial report tells a story. But here's the thing. The story you see on the surface, it isn't always the real one. We're going to learn how to look past all those official headlines and uncover the truth that's really hidden inside the numbers. Okay, let's just dive right in with a bit of a puzzle. Picture this. A company is making millions in profit. I mean, its shareholders are thrilled. The headlines are absolutely glowing. But behind the scenes, its bank account is just draining away. Is that even possible? Can a company look wildly profitable on paper but still be speeding towards bankruptcy? Well, the answer is a huge yes, and we're about to find out exactly how. So our investigation is going to start with the official story. The one that everyone sees first. But as you'll see in a minute, it's just one piece of a much, much bigger picture. Here it is, our first piece of evidence, the company's statement of comprehensive income. And if you look right down at that bottom line, profit after taxation, you see a big, healthy number, $10 million. I mean, on the surface, this looks fantastic. A successful company making a ton of money. Case closed, right? Well, not so fast. And this brings us to a really fundamental truth in all of this. See, profit. Profit is basically an accountant's opinion. It's based on all these rules about when you recognize revenue and expenses. But cash is a fact. It's the actual money, the real dollars and cents flowing in and out of the bank. And to find the real story, any good detective knows you always follow the money. So that brings us to our most important tool for this investigation, the statement of cash flows. This document is incredible. It shows us exactly where every single dollar actually came from and where every single dollar went. The statement of cash flows is pretty brilliant because it breaks everything down into three really simple categories. So first up, you've got operating activities. Just think of this as the company's salary. It's the cash it makes from its main day-to-day business. Then you have investing activities. This is where it spends money to grow, like buying new buildings or fancy equipment. And third, there's financing activities. This is all about how it gets money from the outside, like taking out loans or selling shares to investors. And this diagram just shows you how it all connects. You see, the cash from operations, from investing, and from financing, it all flows into or out of one central pool, the company's cash balance. Each one of these activities tells a completely different part of the story. All right, that's enough theory. Let's get back to our supposedly profitable company. It is time to pull out its statement of cash flows and see what secrets it's hiding. Okay, here we go. Let's break down the evidence. Right at the top, net cash from operating activities is a positive $8 million. Hey, that's good. The core business is actually bringing in cash. But then you look at the next section. Net cash used in investing activities. Whoa, a massive negative $20 million. They spent a huge amount on new property and equipment. And to help pay for it, looks like they brought in $5 million from financing by issuing new shares and taking on more debt. So, what happens when you put it all together? Let's do the math. You start with the $8 million that came in from the business, you subtract the $20 million that went out for those big investments, and then you add back the $5 million they got from financing. What's the final result? The big reveal? A net decrease in cash of $7 million. So let's just put our two stories side by side for a second. The official story, the one everybody saw, was a nice, big profit of $10 million. But the real story, the one that cash tells us, is that the company's bank balance actually shrank by $7 million. Wow. Suddenly, our little paradox makes perfect sense. Okay, so the cash flow statement gave us the major plot twist. But to get a really complete diagnosis, financial detectives use another set of tools. You can think of these like the vital signs that tell you about a company's deep underlying health. These tools are called financial ratios, and they let us investigate all sorts of different things. We can measure profitability, its efficiency, its short-term health or liquidity, and how much risk it's taking on with debt, which is often called gearing or leverage. Basically, each ratio is another clue in our investigation. Let's just look at one to see how it works, return on equity or ROE. This is a super important profitability ratio. It answers a really simple question. For every single dollar the owners have invested in this business, how much profit is the company actually generating? It's just a powerful way to measure how well management is using the owner's money. And this is how you calculate it. You just take the company's net profit and you divide it by the owner's total stake, which is their equity. It's a simple little formula that connects two different financial statements to give us a really, really important piece of intelligence. Now, to see this tool in action, let's take a quick look at another case file, this time for a company called Alexis Limited. So the calculation for Alexis Limited shows a return on equity of 33%. Now, is that any good? I mean, a number all by itself doesn't really tell us much. The real detective work comes from comparison. You'd want to compare this 33% to what the company did last year, and maybe most importantly, to the ROE of its main competitors. That's how you turn data into actual insight. All right, armed with our new tools, let's go back to our original company, the one from the beginning, and put all these clues together to deliver the final verdict. So what's the final analysis here? Well, the strength is pretty clear. Its core business is healthy, it's generating $8 million in cash. That is a solid foundation. The concern, it's spending cash like crazy, $20 million on a massive expansion. So the big risk is that its cash balance is falling and falling fast to pay for it all. The conclusion then? It's not really black and white. The company isn't failing, not yet, but it is taking a huge high-stakes gamble on its future growth. We've solved the case of the profitable cash-burning company, which brings us to our final and maybe most important section. Why does the real story even matter? Because here's the real takeaway. Being able to read the real story behind the numbers, it's a genuine superpower. I mean it. Whether you're an investor trying to pick a winning stock, or an employee trying to figure out the health of your own company, or a business owner managing your finances, this skill lets you see what other people completely miss. It empowers you to make smarter, better-informed decisions. Every company's financial statements tell a story. There's a surface plot, sure, but there's a much deeper one underneath. So the only question left is, the next time you look at a set of numbers, what will you be listening for?